Okay, hello and welcome to this conversation on GBI video. Today I will be speaking to Lucius Cary. He's the founder and managing director of Oxford Technology. Lucius has a very interesting career, quite literally writing the book on venture capital. It's a great conversation. We talk about his career, the state of startups and investment in the UK, EIS, venture capital, and yeah, I'll let it speak for himself without further ado. But Oxford Technology, you're doing SEIS and EIS,
yes, yeah,
which is SEIS especially, is very risky, into one sector essentially, which is sort of science, technology, sort of
yes, correct.
And so I'd just like to get your thoughts because that's high risk, but I expect that's a good thing. Or you'd see that as a good thing. Positive development from career.
And so, I'll tell you why. This is a really interesting point. I mean, the SEIS scheme is absolutely brilliant for what we do. And the way it works is you get these enormous tax breaks. In fact, when the SEIS scheme was first announced, can you believe this? If you invested £100,000 in a business and it failed, you ended up with £105,000 as an investor. I could not believe it. When that was announced, I heard it on the radio and I rang up the Treasury, and I know the people in the Treasury, and I said, listen, can I come and discuss this? And I went through it. I said, okay, so I invest £100,000, I get £50,000 back against my income tax, yes, and you get, I can't remember what the numbers were, £22,500 back against your capital gains tax, which is not really, it's not merely deferred as with the EIS, it's cancelled. And then if the business fails, I get all the stuff back against my highest rate of tax, and it worked out at more than £100,000. I said, that is just amazing. And they said, yes, they said that, the Chancellor, which was George Osborne, has decided that the UK economy is in a mess. And this was, in 2012, so just after the sort of fallout from the financial crash of a few years earlier. And, what we need is more startups. The startups are the things that create jobs and employment in the future, and large companies are shed labor. And but investors won't do startups because they're too risky. So this is going to change the culture. And anyway, so it's absolutely perfect for what I was already doing and had been doing for 20 years. And so we then formed an S, and the reason mathematically, what will work if you're doing an SEIS fund is to make the highest risk, highest reward investments. If you make 10 investments and 9 of them fail, and your losses on those are like 1, and if the one that succeeds multiplies your money, 20-fold or 100-fold, you do really well. And what doesn't work is if you invest in 10 low-risk businesses, which are also low return. So then they all, 9 of them succeed, and they all make, 10% return, let's say. Well, the person who's taken the big risks will do much better. That's what the math says. So, but it's still despite the breaks, the tax breaks, people are still very risk averse, or a lot of people are. But it is changing. People are getting better.
Right at the start of this conversation, you mentioned, you just compared your experience raising capital to the sort of experience that, or what service Oxford Technology offers people now. Maybe you could just tell me that again, and then upon talk about reflecting a little bit, that'd be fantastic.
Okay, no, fine. So what we do when we want to raise capital, well, when our companies want to raise capital, so like Lightpoint, for example, when it needed to raise more money, we did a presentation we call them presentations and we used to have them in London, and we would book a room somewhere, and then we'd invite all our investors, And typically about 20 or 30 investors would come. And then, we'd spend a morning and there would be a presentation done, and maybe people would raise money or maybe they wouldn't. But now we do it by Zoom. And so now that's much better. So now we get 60 or 70 people come. And we did one just a couple of weeks ago, and we only had one company presented. It wanted £54,000. And they presented at about 10 past 10. And by 12 o'clock, they had all the money in their bank account. People had sent electronically the money. So, and that for the company, the person who was doing that fundraising had been involved in lots of fundraising during his career. And he said, I've never known anything, he said, like this. He said, it's fantastic. I've taken 9 months to raise money before. Being able to raise all the money I need in an hour is just brilliant. And that's so very pleasing to me to be able to help founders in that way, because it's so time consuming talking to investors. And often during the 9 months it may take to raise money, the business suffers hugely because the 4 founders are not being able to concentrate on their technology or their marketing or the things they ought to be doing. They're spending all their time talking to investors. So anyway, that's been a good benefit of COVID.
That's okay. I've got questions. I've got questions. Going to ask them quickly. So EIS, the EIS scheme. So It's safe to say now in Europe, the UK startup scene is very strong. Looking at fintech and what you guys are doing through EIS. I was just wondering, as the man who wrote the book on venture capital, how much does EIS and SEIS, how much has that contributed to the startup scene? In the
UK? I mean, it's over the 30-year period. I started in 1978. I had my first fund in 1983. And in 1983, there was just nothing. There were very few funds, and it was almost impossible to raise money for startups. Very difficult. And I kept seeing all these. Like I knew 2 people who they wanted to make a laptop computer. This is, I can't remember, in the early 80s. And so they went round talking to people and said, look, a laptop. Who's a laptop? Well, who wants a laptop? And they couldn't raise the money. And they subsequently started another business, and they both became, huge multimillionaires. Sophos, they started, very successful businessmen, but they couldn't raise money because, people just said, oh, just so unimaginative. Anyway, and what a waste. I mean, it might have been, another Intel, it might have been another Apple, who knows? But it never got off the ground, and it's been such a sort of the waste that we've done in this country with all our great science ideas, and simply not. I mean, it has got a lot better, but it still could get a lot better still.
Okay, that's another question. That's if you could make any changes to the EIS scheme, what would they be, if you could?
Well, one thing is the difference between SEIS and VCTs. And in VCTs, and I simply don't understand why the Treasury and HMRC do this. I mean, I don't understand it. But what happens is if you invest in a VCT, the VCT has, I can't remember, I ought to know, but I think they've got 3 years now to invest the money. But the investor gets his tax relief on the full amount he invests in year 1. And then the VCT has to invest 80% of the money in, mostly already profitable businesses that are floating on AIM, which don't need help anyway. So, why you give all this tax relief for that, I never known. And whereas if you invest in us, we take 3 years to invest our money, but you don't get your tax relief until the money is invested. So it takes our investors 4 years to get their tax relief, whereas if they invest in a VCT, they get their tax relief up front. So why the discrimination? And the other thing is that dividends from a VCT are tax-free, and dividends from an investment from one of our companies is taxed. So why is the playing field so unlevel? And it certainly works. The Treasury's succeeded. We in the last year raised less than £1 million to invest in our things. VCTs, I can't remember what the number was, but 600 million or something went into VCTs. And yet the Treasury says, oh, we really like what you're doing. You know, you're backing startups. That's what we like. But then, and if the only way out is to sell your shares, you know, that's what you have to do. And the Treasury themselves had a review a few years ago called Patient Capital, one of the themes of which is that, you know, capital in the UK is too short term. And then the Treasury themselves then tax dividends, you know, from us, but not from a VCT. So, you know, the only way out is to sell your shares. Whereas, you know, it'd be much better if you could keep the shares and get a dividend once it starts to work. So that's a small technical point, but it's very irritating to me. You know, and then I remember once I was in the Treasury and they asked me, they said, why did you do a VC? Why didn't you start an EIS fund? And I said, I couldn't remember. And I said, oh, I remember why. Because if you raise an EIS fund, the Treasury required that all the money was invested in year one. Mm. I'm not going to do that. I mean, that's so short term. It means you invest all your money in year one. Then what happens if you're not able to raise money in year two? You can't support your existing investees. Mm. You know, it's just you're building in super short termism while complaining that the UK is short term and you're the ones causing it. Mm. It's just absolutely infuriating.